Good morning, good afternoon, good midday to all of you. My name is Mike. We're going to start in a minute. Thank you all for joining. I see quite a big turnout today. I'm very happy to see that. We'll give it another minute and we'll start nice and sharp on the dot. Hope everybody is having a wonderful day. Right, for me it's 1 o'clock right now, so let's get started. Probably a few people that will come in late, but can't wait for them. All right, so welcome everybody to today's webinar presented by me, Mike Rotink, hosted by LegacyFX. It's going to be technical analysis for beginners. To get into it, first of all, the risk disclaimer. Take a moment to read this. Legislation and everything. All right. Now then, what we're going to discuss today, I'll introduce myself a little bit, give you a little bit of background information about myself, what I do, and how I ended up presenting this. Then, regarding technical analysis, first we will look at the basics, meaning trend lines and resistances, and how to use that to predict movement. We'll then discuss how to actually read your analysis properly. Drawing the lines and then understanding what you're drawing is two different things. We'll discuss quickly about the trade itself. So once you are in the trade, what to look for, how to adjust your lines in case needed, and what kind of things to not get thrown off by, which I see a lot of traders do. And lastly, we'll have a Q&A session. I roughly put an indication of time in all these things. It'll change. It could be that the Q&A is a bit longer. Now then, moving on, about me. Well, like I said, my name is Mike Rotink. I've been trading a little over 15 years. I think I'm 18 years now, give or take. I started fairly young, about 21. As most people, I kind of bumped into what was then binary, and that sounded like fun, but quickly came to realize that that isn't actually trading. So I looked into FX trading. And like most people, I started looking at, okay, so what do I do here? How do I trade? Very little money, obviously, as a student at the time. So I have very small accounts. Like most people start, at $250, $500, somewhere around that region. And it quickly came to me that the regular way of trading that you're told to trade, in general speaking, just doesn't work. And trading bots and things like that, they sound amazing, but they're not. So I started trading for myself and really trying to just teach myself how to trade based on the information that I did have, which is the market information itself. And I stopped listening to people, basically. That turned out to be a great success for me. I ended up keeping from the third account. I didn't lose any more accounts. The first two I flopped, which is part of the game, to be quite honest. We'll get back to that later. Lessons learned. Third account started going good. After that, I grew. Now I'm to the point where I don't have to trade directly into the market anymore. I now invest in structured notes in multi-asset funds by Goldman Sachs and JP Morgan. So I don't have that direct influence in the market. I still dabble in it, obviously, because, well, it's hard to lose old habits. So that also ties into what I do. Apart from giving training and doing these webinars, obviously, I do some trading myself. And on the side of that, I am just enjoying life in general. But enough about me. So the basics. So what we're going to do is I'm going to switch to the MT5 I set up from LegacyFX. It's going to be a blank canvas, and then we're going to get started. First thing we're going to discuss is trend lines. Then we'll look at resistances, and then we're going to use those to predict movement. or to understand how to predict movement. Now, first of all, when we talk about trend lines, what is a trend line? So in a lot of cases, I see people saying, okay, trend line is the direction it's going, right? That is technically not incorrect. That is what it is. But then I see people doing something like this, and they trade 5 minutes or 15 minutes. You're not determining anything on this time frame. What the market does in the next 5 minutes has nothing to do with what the market really is or what it really is doing. And you saw that I was set for a month. Now, I don't expect you to trade on a month. Nobody does that, at least not in this. First, you need to understand that there are two ways to trade in a market, and that is by timing or by time. Now, I have moved to time in the market and not timing in the market. When you're trading on an FX platform like this, you need volume and consistency and frequency. So timing, you rely on those timings. So you're not going to look at a month and set up a trade that's going to run for 4 to 6 years. You're going to look at something that's going to run for a day or two, up to a week, maybe 2 or 3 weeks, but generally not multiple months. You still do use the month, however. Now, when doing any technical analysis, the first thing you should learn to do is something called a drop-down or top-down analysis. To make you understand what that is, you start at the highest time frame you work with and work your way down. That said, you will take a brief look at the month, and you should not go anywhere lower than 4 hours, an hour tops. Anything under that, you go into a territory where you're not trading, you're trying to scalp and do very small movements. There is when you go to my webinar about risk management, it should be next week somewhere, this is a terrible idea, especially when you have a smaller account, because in the long run, you will never win. This is kind of the casino idea, right? If you keep playing, eventually you'll lose and the house wins. You need to play smart. The less capital you have, the less you can spread your risk, so thus you need to play even smarter. You don't have any wiggle room. All right, so let's actually get into this technical trading. Right, so first of all, we need to determine the trend. Well, if we take here, this is the Euro US dollar. I figured everybody knows this one. So when we just look over it in the scope of 2015 to now, in the last 5 years, it's really not done all that much, right? When we look at the top and the bottom, we went down to a 1 and we were up to 124-ish. That's the scope, right? That's the entire scope, 20 cents. Keep in mind, again, we would like to have this whole row. That's the last few months. So this is what we care about. I don't care so much about 2016, 2015 anymore, because that's historical in the sense that we don't really have to worry about that all that much. But determining the trend, as we can see, if we do the trend here, there was a downward trend, right? For the entirety of 2018, 2019, up to the start of 2020, there was a downward trend, right? We see the market going down. So I could say, okay, so this was the trend. Now I'm going to explain how you draw this line properly in a second. Bear with me. Obviously, that's no longer the case. We are now moving in an upward for the last few months with 2 months interline. And this is a normal pullback. This is a different webinar again on market behavior. But we have the lowest point being here where it's crystallized, and then something like this. Now, this is a trend line, except it doesn't follow my rules that I'm going to tell you what you should focus on. And that is 1, when you draw a trend line, you try to find at least 3 solid candle connection points, minimum. Otherwise, it's just too weak of a line to work with. Now, in a month, obviously, these sprites, these needles, they're much more solid than they look on a chart like this, because it's obviously a 30-day period, or 31. But let's take this out. We just know, okay, for the last few months, it has a tendency to move up, right? I think everybody can agree with me. For the last 8 months, 6 of them were up, right? So this little pullback here, it's nothing to really worry about. We'll get to that with resistances in a minute. So let's go to a week. This is a bit more interesting. This is where most of you should start, even if you're trading on an hour. Now we're going to do something fun. First, we need to determine if it is a downward trend or an upward trend. We know this is a upward trend. So we need to find the lowest point that started the trend. And that is your point to start the line. I see a lot of people trying to manipulate the line so it fits their narrative on, oh, my indicator said, or my, forget about that. We're talking about technical analysis here. I don't care about indicators right now. So let's take a look at this chart. First, we have this whole plateau here, this period, where this would be the lowest point. But this is not the start of the upward trend. This is the consolidation phase, right? It came from a downward trend, tried to recover, fell down, tried to go back up to the top, fell down again, moved sideways for a month or two, and now it started going up. Again, we don't have 3 connection points because the trend is just too young. So you could say, okay, I can go like this. Not really. We can already see where the problem comes in here. We're basically going off into space here. So this is the only logical connection point I have. Now, we don't have 3 connection points, but we're talking about a week here. So we do want 3 or more connection points at the very least. Unfortunately, the market does not provide us one at the moment. So we're going to have to assume this is the forming trend line, not a fixed established one. So it's an indicator, right? It's indicative, and that is all technical analysis is, or fundamental, or any other thing. It's indicative of what it could or roughly can do within a certain range. Here is a perfect example. I'm going to lock this in. Now I'm going to keep the color on this line. I'm going to get to this in a moment. We're going to do several of these in the same chart. And it'll become clear in the end. I have one prepared for the end. So this is the first trend. Now I use this one, equidistant channel. The reason for this is that it gives me the range straight away. As you can see, there's a clear channel here, or there's a clear channel forming because this one's equal to this. There can be a scenario where this bottom line has 3 connection points and the top one touches basically nothing, except for 1 point maybe. In this case, we have several spikes that it hits. So that's okay. Still not amazing, but you can say, okay, then I'd rather do this. That's okay, but then you have to keep in mind when you have your trade running with your stop loss and everything, that you have this margin that you need to factor in. It's basically what Bollinger Bands does, right? So I'm going to put it back here where I have at least 3 spikes that I'm trying to tip, because that's a little bit the average that's good enough for me. It's an indicator. I'm not going to open trades on a week anyway. They're just for me indicators. Okay, this is what I want to get in, and this is what I want to get out, which is what we're going to get to a bit later. So for the week, I now know that this is the dominant trend and its range. So let's go to 1 day. And now it's going to get a little bit bigger. So let's squash this down a little bit, zoom out a little bit. Now you might say, oh, look at this. It's going through the candles. Yes, because we were looking at a week, not a day. And this is why this is important. So for the last few days, it's again been moving up after it's been going sideways, which is a consolidation phase, the first rally or run, right? So start of trend, pull back. Now, if any of these terms are something you don't know, look at some of the basics of trading, because these are terms you're going to run into in almost every webinar. What is a pullback? What is a consolidation phase? Things like this. All right, we don't have time to get into that now. So we have the second phase, and then we have a consolidation phase, which has been going on for quite a while. And now it seems to have finally broken a certain resistance. We'll get to that in a second. So here we can say, okay, now we're finally starting to see something. I would say this is the first candle, second, and it barely tipped that one. Market opening was a bit weird. So we're going to pull that out, and we are working within the channel going this direction, and I want this one a different color. Now let's say for day we're going to use, I don't know, navy blue. So why do you do different colors? That's going to come in because you're going to add, you're not going to delete any of the lines. I want to know from a daily basis where's the range, because if I want to open a trade, I don't want to open it at the top of the day. I know that in this day, most likely we hit the week here. The highest ranking time frame overrules the lower ones. A week trend line is stronger than the trend line of a day, which is stronger than the trend line of 4 hours, an hour, so on. This is why you do top down. You find the strongest, the most stable ones first. Because if you look at a month, not a whole lot happens. In the history since 2008, it was going down, and it actually just broke it now. But that doesn't mean we already know this. We're already looking at that point. This historical data is okay, but it's more interesting if we're doing stock. We're doing FX. Now, so we know we're in the top of the day channel, and just as we indicated here, it is starting to bend away from it. So let's go even more detailed. Now let's go to 4 hours. This is where the majority of you will have your trades open and close based on the information on the 4 hours correlated with a week and a day. All right, so we take the same point again. Now within the day, it's been in the bottom half of this channel. It's finally gone to the top half of the channel. But it's if we cut this channel in half, right? So I just cut it down to the center. Although we're having an upward movement in euro US dollar, it is predominantly on the southern side of the channel. So this is the most risk-free part to trade in. We want an entry point as close to this bottom line as we can get. But there's a few other factors, right? So we figured out this. Now within the 4 hours, we can now say, okay, the last one started somewhere over here. It hit that day line and it moved up. And again, we only have 2. Well, 3 is the arguable one here. And I said at the start, and there's a reason I picked this frame, because I noticed we don't have a solid 2. Like this broke, but did it? Let's extrapolate it further. No, it didn't, because why would it have broken it? It broke the 4 hour, it didn't break the day. So for those that trade in smaller time frames, so that rely on timing in the market, your next entry point should be here. We extrapolate this sideways somewhere along this line, preferably as close to this line as possible, because you know it's going to go back into this channel eventually. And let's make 4 hours orange. I hope that's an okay color for everybody. Okay, so 1, arguably 2, 3. And this is equidistant. Now you can say, okay, I'll just move it up like this. That gives me the full range into 4 hours. I mean, yeah, you're not wrong. But now you're just using something from the last 8 hours that's not really, I mean, it's already going down based on this rally. So you can indicate, okay, this is an abnormal movement considering to the recent history that I have. It's an abnormal jump. So this will probably pull back. And the funny thing is, it probably, if we look tomorrow, it will have pulled back into this line. Saying probable. This is just how I used to think, not how I still think. All right, so I hope this clarifies trend lines a little bit. Now this is the channels. Now if we go into an actual trend line, now we're going to complicate things a little bit. Now that we have our channels, we know, okay, this is the ranges that it wants to work in, and that is the trend. The trend is this direction. So the average, the median would be your trend, in a sense. But we also want to find out, is there a converging or a diverging trend? Because they're not always perfectly like this. In this case, well, it doesn't fit in this channel. And there's definitely a trend going on here. So what if I take the highest first one and move it across all of these? Now what happens? Well, I take that away and now fix the bottom as well. So we have a diverging trend, right? It's from a smaller point and it's moving out of each other. You're not going to see this much in a week, but we are now refining on the smaller frame the trend. The trend starting point and range is slowly broadening on this small time frame. What that means is that the trend in general is getting stronger. It's breaking open the top. So we now know that most likely this is going to start getting stronger and the uptrend is going to hold longer. So now I can say something like this. We have a connection point here that is after my lowest point, never before. You don't do this. It's like, okay, well, I'm going to take this point here because that way I can get 3 points like this. We'll just do this then. Yeah, it's parallel to this one, but what does this have to do anything with this starting point? This is a completely different thing. Never have, they always should be at the same point starting. And in this case, we bring it down. And we had this, so we had a small breakout, which is just correcting back in. But when we follow this trend line, we now also see where it will probably clash with what our daily channel is. So to understand this, it's going to bounce around this line up till this point. And here is where you would close if you have a buy. It's where you would consider closing it and perhaps opening a sell instead. Right, so long short. All right. Now, why does it sometimes term in the middle of nowhere? Well, this is where resistances come in. And I know this is complicated, but let's go back. So in a resistance point of view, this is a horizontal frame. It's a price point where the currency needs a push to get through. It needs a reason to go past that point. The trend is just a general market fluctuation. If you historically look back 30, 40 years, generally speaking, most Europeans move up. Recovery after 2008, we're back at the same point. So from a financial currency point of view, right, it's been moving up, and in 2008 knocked it down, but the recovery after that has been up. For those that don't understand that, welcome to the early 2000s. All right, this is speculative on the strength of the euro before it was implemented. So 89 it was implemented somewhere. We get the correction, and this crash was 2008, which then, recovery, crash. We all know the recession. And that has, if we look at this historical point of view, the euro is still struggling versus the dollar, but it's found its median again before, the big climb. Now, for a resistance, we do see one very interesting one. And this is the same drawing technique or rule as I mentioned before. What you want to find is 3 or more solid connection points along your horizontal axis. So for instance, if I take a look at the recent few months, this was the highest point. And I always do the highest one I have red, just a red line. It doesn't really correspond here though. So now the question is, should I do this? Because now you get that question. Is it this? Or is it this? Or is it this? Well, the reality is it is this one. And the reason for that is very simple. This is the most recent market situation that does have correlation with the previous historical market situations. It's not entirely to the point, but this is the most recent. Obviously, you're not going to trade now in Corona time with a new US president, for instance, on the euro dollar, the same way you would trade it on 2012. This is understanding that the market has changed. Thus, you get a small shift in price points. So always use the most recent one and then try to get connection with the past, but it doesn't have to be perfect. Right? There is some leniency there. And for the month for the bottom, we know the lowest resistance recently, if we look in the same time frame, well, you can either take this one, I would take this one just because it has that solid 3 connection point right here. So we know that this would be the absolute bottom, which it is, the 105. If it drops below that, Europe's in some problems. Now, so let's go back to a week. And what did we decide for a week? Brown. Right, so we're going to just plop that in there. And that was, let's make this line thicker. And that's, what color is that? Maroon? No, something like that. You can make them a little bit different. Let's make this bright red then. There we go. If you're colorblind, obviously, my apologies. You would have to use different shades of gray for yourself or other colors that are easy to distinguish for yourself. But the concept is the same, right? It's just for you to know that when you're looking at a certain time frame chart, which line am I looking at right now? What is relevant to the time frame I'm working in? When you're working in 4 hours, you're not looking at a month trend line. It could go straight through it. Right, so back to resistance. Now let's say, okay, well, why don't you do this? That's the lowest point you had on the resistance. Sure, it is. But first of all, it doesn't comply with a rule. I only have 1 connection point here. And 2, it's very close to our monthly, which is the overruling one. So there's no reason to put this one in, because when I get to this area, I want to be looking at this, which is the absolute. Then I want to make my decision based on this line, not this line. So let's move it up. So here we have a good solid plateau, the consolidation phase that basically stopped the whole downtrend. It broke through once and then bounced back up, and it bounced off of what we know is the monthly trend, right? It tried to spike towards that. So we can determine that this monthly trend probably shifted a little bit up in the few years that passed, but it's a range. The supply and demand zone is something we can't really get into now, but that also plays a part. Obviously, there's a lot of different factors. We're just very basically looking at technicals here. Now, so let's go back in. What were we? Week, sorry. If we look here at the bottom plateau, I would argue this one. Now let's take a look by taking these two off. Is there any historical significance with that on a weekly basis? Yeah, there is actually. We can see if we go back just a little bit, 5 years, there was a big plateau that bounced between these two lines. So this is definitely something that is relevant. And it was relevant for this entire plateau as well. And it tried to poke through and hit the monthly a few times. Here for 3 weeks, it was below. But that was it. After that, for the last 5 years, it hasn't been down that line. So I would say this is a very, very solid line that you can go with. So sometimes when you're at the bottom, you need to go back a little bit. Make sure to take this one off because otherwise it just keeps bouncing back every second. And use this one so you have room to extrapolate. Okay, so let's keep putting the lines in. So now we're going to go into the smaller time frame. Now, and trend lines, remember we have the 3 rules and we don't want to cut through things. In case I forgot to mention that, I apologize. You do not want to do something like this because you're cutting the entire corner off here. And that's a big no-no, right? Your channel or your trend is where you want to stay inside. So you can't go straight through different trends, right? Unless you're, like I said, you're dabbling in these kind of non-existent times for me, but you should not be playing with this. But in 15 minutes, obviously the trend is different than in a day or a week or a month because it changes 16 times a day. But it doesn't matter because the movement is so minute, it's irrelevant. And it's also unsustainable for you to try and trade on that. I'll get to that later. So let's focus back. So we have our weekly trend. Now, why did this one change back again? Oh yeah, because we changed this one, right? So we have our weekly here that we determined. So we lock that one in. Just double click the line and it'll lock it in. That way you can't accidentally delete it or move it. Now, obviously our active market is here. So all the way in the bottom, don't try to figure out every single step along the way. Let's just skip. You don't need to do every single one in between because it's not relevant to when you're trading right now. This area here would be like 10 weeks away from now if it does go straight down, unless it's something really interesting like this. And even then, we're still talking several weeks. So don't spend a whole bunch of time on this. But this we do care about, right? So that would be a retrace moment. So let's see, we have connections here, then we go across. Kind of lose it there though. What if we do it a little bit lower? No. So this is the strongest option I have to the most relevant current market time. This part here, I don't care. That was a downward trend anyway. We're in an upward trend, so it's not relevant to my current, what I'm trading in now. This is most recent, so this is ruling. I'm pretty sure, oh, there you go, boom. It was a little bit lower, like we said, a few fundamental changes, it shifted a little bit. Good. But we're going up, so I want to know where's the next point where it could turn. Well, now we do have some historical data because we obviously I can't see anything above this point. I can do this. Now, if I need to zoom in a little bit. It's important that you have a good monitor, by the way, because otherwise things are going to be really tiny and you're not going to have a good overview. There's a reason we use 6 screens. Right, so we know this reason, but I don't really care about this. This was a consolidation phase. It broke through that. Okay, clear, it's going up. I can still use it because maybe for the pullback, like if it hits this line, perfect entry point. But it's a week. Let's go a little bit bigger. I want more range. So the best thing I can do now is just do look at the historical point where This is the bottom end, which is coincidentally going to be the resistance. And that is the same range as this. And now we see there's a little bit of a correlation between the distance here, here, and here, which is going to become more efficient and more clear when we go to a day. So in a day, we're going to do the same thing again. Let me change the line to blue, because we said for day we use blue. So we're going to use blue. And now you can see I'm looking much more at the very recent, and here is that weekly. So the weekly and the daily resistance correlate here. So I'm not going to put in the blue line because there's no point. What I can do is fill the gap here, because that is where I am trading right now. The market is in this. I'm not going to do these. Why? I'm trading in this area now, this range, these 2 price points within this trend. So when this trend reaches this point, like I said, look, diverging trend line, they all end up in this quadrant here. So most likely this is where it's going to stall for a while. Either that or breakout. And then it will break out to here. So here we do the same thing again. We already have this one, so we just move the line up. Is this relevant? No. Is this relevant? 1, 2, this whole thing got held back until it like basically got cornered and had to move. 2, okay. What if I take the middle of these 2? Wait a minute. There's 5 trading days. It's about half of a week. There's some correlation there, funny enough. So here, we can safely say that this is probably the strongest daily resistance we have. Because remember what we're doing. We're opening and closing on 4 hours. So here, we're going to do the really detailed in-between stuff. Not on a day. This is good. So for daily, or for the 4 hours, we used what was that color? The orange, chocolate? No, orange, right? Yeah. And here I tend to use a dotted line because it is the weakest trend line, or the weakest resistance. My apologies. Right. So we don't need to do this one because this doesn't make any sense in 4 hours, as you see, because we're looking at a day. We know, why does this line make no sense to me? Why is it here? Oh, I'm sorry, it's blue. I should be looking at that trend line in a day. Oh, now it makes sense. Right, this is why you color code your line, so you know what you're looking at. So here we clearly have a top here that does correlate with this point, and this point. How much time we have? 1:37. Okay, we're on schedule. Okay, good. So you don't have to have a perfect connection, by the way, right? It's an entry point indication. It's an indication of when it might turn or it might slow down. This is where you decide to go either in or out. You don't do anything else with it. And again, we don't have anything here to really go off, except, okay, we have this here at the top where it recently turned. Let's see if that's relevant. Well, let's follow the line. We put it on the top. Now, let's zoom out a little bit. Where's the line? So our line is here, the 120 line. Let's keep going back. Oh God, we're going all the way back to that bottom trend. Oh, I'll probably have to go all the way back to 2017 to find relativity. Oh, here it is. Oh, look at that. It's a perfect connection almost with these tops. So was the indicated trend line that we put in for 4 hours here valid? Yeah. Could you have known that when it broke out here? Not really, because you're looking at something from 2017. But that's why you have the trend. You were in a buy here anyway. And if you weren't, you're trading against a trend. And unless you have $100,000 as an accountant trading on a micro lot, you're an idiot. I'm sorry to say it that way, but that's how you lose money. You know the trend is your friend. It's not entirely true, but in general, it's, especially if you have a smaller account, you should be trading with the trend, never against it. You're basically just betting against the market. You're not Rockefeller. You don't have the capital to do that. Right. Neither do I, by the way. So the last one is we have this turning point. Now this is then the determining where, okay, it's close to the day, so it's probably the daily trend. So I don't need this line. I've now have it split up. If you take a little bit longer for that, you end up with something like this. And in this case, I used purple, I guess. All right, well, my apologies, purple. And you can see how it's split up. I just didn't put this one in. So put that one in there. I guess I made it purple. All right. Dark violet, same thing, whatever. All right, so I now have a perfect overview on the 4 hour with the resistances. I can now predict movements. How? Well, I know that if it's in the bottom here, close to the daily resistance, it closes that day above this line, I just open a buy. I don't even have to think about it. The probability of it going up far exceeds the probability of it going down. So that's my best bet. It's a calculated risk. We'll get to stop loss and stuff, everything else in a different presentation down the line. Okay, so now let's understand our analysis, right? So what did we just do? Well, first of all, in a bigger picture, we have determined what is it? Oh yeah, I forgot it overlays with the other one. Okay, forget about that. Bloop. This is cleaner, I think. There we go. We'll edit that out. Right, so what do we do? Well, first of all, we determined what is the range and general direction that this pair is moving in the near future. We have also determined what are possible turning points or slowing points unless there is a reason to break them, resistances. Now, if you're wondering what is a support versus a resistance, it's very simple. A resistance resists the continuation of a movement. A support stops an opposite movement. Very simply said, if the trend is up, like it is now, everything under the market price is a support because it will stop it from dropping lower and pushing it back up, supporting continuation of the trend. Anything above it is a resistance because it tries to stop and revert the trade. It's literally the same thing, just it depends on what direction we're moving. Okay. So we now know how this will help you trade. Well, basically, it helps you understand where your entry points lie, right? Especially when you're trading, let's say 4 hours. That is huge. All right, here we go. Let's say we're trading 4 hours. Right now, I should be in a sell. And if your question is, should I go in now even though I'm late? Yeah, you can. You just need to factor in that this stop loss should be higher than that. Right, so you have to, if I go in here, my stop loss is there. You go in here, your stop loss is also there. I take way less risk than you. My profit point is the same as yours. Entry points. Anyway, so we're moving on. Sell. I can expect that it will roughly go back, considering this is an abnormal movement that we had before. Abnormal as in it's a not really a breakout. It's just a sharp spurt of growth, right? A small breakout to the next resistance. It will probably pull back to the daily resistance or the bottom of the trend. So if I would have a sell, this is where, when I start getting close to these lines, is when I want to decide to go out, not before. Right, so that also means that, okay, for the next 3-4 hours, I don't really have to look at it, but what I can do is like, well, I don't want to take the sell now because it's against the trend. We just discussed that. I'd rather wait for the buy. But when is that? Well, let's take a look. What is the average decline? So does that correlate with that one? Well, so we can say on average, it like dips roughly that direction. So yeah, somewhere around here, it should hit close to that. Right, this is based on how sharp these fell, historically speaking, like average. So I know roughly around here, okay, give me an alarm. Where's that alarm? Hello, alarm. Not here. Don't set a buy limit, please, for the love of God. Don't do these things. Manually open your trades. Don't put pending orders. I just want an alarm, and do it on your laptop or PC. Do not do this kind of thing on a tablet or on a phone. They're great for monitoring your trades, making very minor adjustments. They should not be your primary tool to work your trade in. You just don't have the screen size that you need to properly do your work. Okay. Now here's a few important points. And let's go back to this. Psychology. I get a little bit sick in the stomach every time I hear some self-proclaimed trader guru say, well, it's all about your psychology and how you enter the trade. That is the dumbest thing I've ever heard. Trading is a systematic, analytic way of understanding how and why a market moves and trading on that. You have statistical data pointing out what happens. If you trade with a strategy and a system, psychology is irrelevant because you have facts that tell you what that strategy should do. And you can backwards test it at any given time, and it will work in every single market of the same type, obviously. You cannot compare FX with the equity market or commodities. Commodities have a similar movement, but they're way more demand and supply influence than anything else. But anyway, psychology, it's more for yourself. What I mean in this is you need to trust your system. Once you've developed a trading strategy that you've backwards tested, that if I would go in here based on my technical and fundamental analysis and my indicators, if you're using them, but you should, you have an entry point. If I take that sell or that buy, what happens? What's the result? If the result of that is 60% or 70% turns out to be a winner, if I just let it run, then you just let it run. Stop touching it. The worst case scenario, no single trade should ever have the risk of zeroing you out. And that comes to risk management. With proper risk management, that first point, psychology, like you're anxious and you don't know what to do and no, you have a system, trade the system, it works. You need to develop it. I do a webinar about that as well. So, when you see it come up, definitely join that if you want to learn how to do that, how to set up a trading strategy. But your risk management is your key staple. It's even more important than the trade itself. It's not about having a high win rate. I can show you accounts with 95% win rate that zero out after 3 years. because the 5% risk that they take overvalues the entire value of the wins. That is the dumbest way to trade ever. I'd rather have you win 30% of your trades, but the 70% that you lose mean nothing. They have a dent of 2% in your account. Every win is 15. It's a numbers game. It's not like I have a gut feeling with the market. No, you don't. You might feel a turn coming, but that's because your brain is interacting with everything it sees and it's analyzing it. And then there's duration. And this is the very important thing I want to point out. When you have your technical analysis combined with fundamental and your indicators, like I said, time in the market, timing. All the big funds that I'm involved in, they all run for 4 to 6 years and have an option of closing early if certain criteria are met. But in general, that's how long the trade runs, 6 years. Because historically speaking, there's generally, obviously it's a big mix. That's part of risk management, diversification. But it's not about, okay, I go in now and 10 minutes later I'm out of the trade. Yay, I made 10 pips. That's great. Try doing that 100,000 times in a row to start making some money without taking an equal amount of risk or more. I can guarantee you that doesn't happen.